All right, welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Ryan Kimmel.
Yo, yo.
Ryan, it's 10 a.m. Pacific time here on February 28th. As you mentioned on the trading desk earlier, January was the longest month ever, and February was the shortest month ever.
Agreed. Yeah, absolutely.
Yeah, it seems February just seemed to fly by here. But let's get into where are we for the month and for the year, and I guess for the week too. Let me get a refresh here so everyone has up-to-date information. On the week, S&P had a pretty terrible week, down 2.6%, down 2.9% for February, and we're at down 25 basis points or so for the year-to-date basis. Looking at the individual sectors, tech was the worst performer by far in for the past week, down almost 6% on the week, followed closely by utilities, down 2.5, call it. And let's see, number 11, consumer discretionary down 2.6. Month to date, though, consumer discretionary, the worst performer, down over 8%, almost 8.5. Tech down 4. And let's be a little bit positive here. Okay, so on the month to date, month to date basis, your best performer was consumer staples, up 4%, real estate up 3%, and energy up 2.5. So looking at it, there's 4 positive sectors for February. Month or year to date, though, there's only 2 negative sectors: consumer discretionary down 5, tech down almost 5%. Everything else positive. And looks like your big winner there on a month or year-to-date basis, is healthcare up 6.7%. So overall, if you look at it, down 25 basis points feels a lot worse than that, given the kind of the moves of the past week and on a month-to-date basis. Month to date, the Russell 1000 is down 3.25%. Russell 2000 down over 6%. Call it 6.25 as of time of recording. And growth down 5.3% in February, and value down 85 basis points. So kind of a reversal of what we've seen here over the past couple of years, where value is outperforming growth, small caps underperforming large caps. And really, it'll be interesting to see whether this continues, whether this is the start of the trend, or whether this is really kind of a speed bump that we've seen happen a few times here over the past, let's call it the last 8-9 months. We've seen a couple of these speed bumps, and see whether that continues or not. I don't know if any of you wanted to add anything on the stock market, Ryan, there before I hop over to bonds.
Yeah, just, it seems like the positive sentiment that we were seeing in equities come off a bit. Seems like market is becoming a bit more concerned with the growth trajectory, and perhaps maybe thinking there could be a bit of more of a fiscal drag with some of the cuts to federal spending from Doge, and maybe that's weighing on the stock market a little bit. And I think you're kind of seeing that theme play out within kind of the underlying sectors, as you highlighted. You're seeing the cyclical stocks really underperform the defensive stocks, which tends to be more correlated and sensitive to kind of like the growth and cyclical backdrop. So it'll be interesting to see how over the coming months how the data progresses, and it's good to see value finally start to outperform. Especially relative to growth stocks, which definitely lagged this week.
Yeah, and you've seen that in the bond market. To kind of switch over to bonds, the 10-year down 31 basis points for February, down 20 basis points this past week, and down 34 basis points on the year-to-date basis. So January was kind of as we talked about, really nothing going on there. So pretty big move there on those. What people are saying is the growth concerns in the U.S. with that big 20 basis point move down in the 10-year. 2 years also down 20 basis points on the week, 20 basis points on the month. So a pretty parallel shift there, at least if you're looking at 2s, 10s. And as you would expect, given that 20 basis point move, positive returns for the bond market, ag up over 1% on the week, 2% on the month. Mortgages, the best performer for February, up 2.5%. U.S. Treasuries up 2%, and investment grade corporate bonds, the worst performer, but still up 1.9% on a month-to-date basis for February. Your riskier sectors. So if we kind of look at high yield bank loans and emerging markets, high yield is up 0.75% in February. Bank loans just barely eking out a very low positive number. Call it a quarter point there. And emerging markets up 1.6%. So your more traditional sectors, a little bit longer duration, doing a little bit better there in February. We're still looking at a 2.6% return for the year to date for the ag. So pretty good returns there from the bond market so far. We'll see whether that continues. At least you can earn that carry over time there. Shifting to commodities, commodities were up 1% in February. Looks like the worst performer was livestock, down almost 5%, agriculture down 2%, but you really did see a pretty big move in energy, up 5.25%, and industrial metals up 2.75%. The kind of previous winner, though, precious metals were flat on the month of February, and really a lot of that move was, or a lot of that kind of give back was in the past week, with precious metals down almost 4% on the week. Bloomberg Commodity Index down 3.5% this past week. So a pretty volatile week, as we kind of expect from commodities. You had WTI crude at $69.88 per barrel today. That's down 1% on the week and 3.25% on the month there. And gold actually giving back a little bit, down 3%, 3.25. Let's call 3.25% for the past week, up only 1% for February, and we're at 28.55 today. So didn't really, we're still kind of bouncing around close to that 3,000 level, but hasn't really broken out sustainably above that. And finally, I see Sam Lau is listening to us right now. His favorite asset, Bitcoin. He did retire at the end of the year. Bitcoin down 18% in February, down 10.5% on a year-to-date basis. So Sam, your Bitcoin's at 83,798 as of the time of recording there. With that kind of wraps up the markets commentary there. Ryan, once you get it, and we had I would say a pretty busy week in terms of the macro front. So why don't you hop right in?
Sure, let's do it. So I think the general takeaway from the economic data release this week was data came in definitely on the weaker side. It kind of kicked off the week on Tuesday with some soft consumer confidence data from the conference board. The February reading showed the largest monthly decline since August of 21, and that was the third consecutive month in decline. So you're seeing that, the initial, pop in consumer confidence that we saw post-election start to kind of roll off. I think markets or consumers are becoming a bit more concerned with, tariffs and perhaps maybe the some of the fiscal drag being discussed out there. And then if you look under the hood at the underlying components that drive the consumer confidence headline number, it's pretty broad-based weakness. You saw weakness in the labor market component, weakness in the business conditions, especially expectations. And according to just quoting the conference board, they were saying that pessimism about future employment prospects worsened with and reached a 10-month high. So kind of a negative read. You saw the bond market kind of rally after that. We also had a series of housing related data during the middle of the week. It included new home sales and pending home sales. And those numbers for January were lackluster. I believe pending home sales made a new record low. And you could maybe say that some of the housing data was impacted by, negative weather impacts in January from cold weather up in the Northeast. And I believe it snowed down in the Southeast, which was unusual in the beginning of January. And then obviously you had the wildfires in the Los Angeles region. So I think that had a negative impact. So maybe take that data with a grain of salt. We also had initial jobless claims on Thursday morning. Those increased. The initial claims number increased 22,000 to 242. That was kind of a multi-week high. That dragged the 4-week moving average up to 224,000, which is an increase, but not at concerning levels. And continuing claims, they remained pretty stable at basically around 1.9 million. kind of interesting if you look through to the underlying state level data. We are starting to see some increases in jobless claims in the DC area and the Delmarva region, which likely signals some of the layoffs that we're seeing in the federal sector. So this is something that we're going to closely monitor over the coming months. We also had durable goods orders. That was a big jump on the month over month. The headline number was up 3.1% month over month. That was driven by a 62% surge in aircraft orders. But when you look at some of the more less volatile components like core capital goods orders, excluding non-defense capital goods orders, and ex-aircraft, that also increased 0.8% month over month. So that does signal that we could potentially see a positive impulse to investment growth during the quarter. Then we had this morning we had a whole host of economic data, including the PCE price data, the personal consumption expenditure, which a couple weeks ago we highlighted that given the inputs to PCE from CPI and PPI, we might see a softish print, and I think that it definitely came to fruition. The PCE headline number for Jan was up 33 basis points. That was pretty much in line with consensus, slightly higher than the previous month. And we saw that the year over year pace ticked down to 2.5% from 2.6%. So it's nice to see the headline number come down to 2.5. The more, the Fed focuses more on the core PC reading, and that was a 28 basis points month over month, in line with consensus and significantly lower than the January reading of last year. So as we highlighted 2 weeks ago, the base effects are really kind of, positive on the year over year basis. So we saw the year over year number drop from a upwardly revised 2.9% in December down to 2.6%. So I think overall a pretty encouraging number, or inflation number for the Fed. If you look through some of the the underlying components, core services was up 20 basis points. That was a deceleration from December. Non-durable goods was really the only area where we saw kind of an uptick. That was up 59 basis points on the month, and that was driven by energy. Super core, which the Fed focuses on, that's core services ex housing or ex shelter. That was up 22 basis points. So that's a relatively benign number. So all in all, as I was saying, I think this was a pretty encouraging print for the Fed, and you are seeing that with the the number of cuts now being priced for this year. The market's now pricing in 2.6 25 basis point cuts. And I think at the beginning of the week, that number was sub 2. So I think the combination of the softish economic data and the weaker inflation data kind of helping the market maybe get a little bit more comfortable with some more cuts coming down the pike. This morning we also had personal income and personal spending data. The income data surged on the month. It was up. The headline numbers up 90 basis points, but that was largely driven by government transfers. If you look through the data, wage income was only up 40 basis points. And then when you're just looking at trend and looking at real wages and salaries, that was growing at 2%, which is essentially back to pre-pandemic growth rates. Personal spending was weak, as we kind of already knew, just given the weak retail sales data that we saw a couple weeks ago. Real spending was down 47 basis points on the month. Real good spending down 1.7% on the month, and real services was essentially flat. When you wrap it all up and look at trend, real spending was running at 3.1% year over year, which is a pretty solid pace, and essentially back to kind of pre-pandemic growth rates. And then we combine the uptick in income with the downtick in spending. We saw personal savings tick up to 4.6% from 3.5%. And then I think another notable data point released this week was the trade deficit for January. That surged to 153 billion. That was much larger than the consensus and the 122 billion last month. So it does appear that this deficit widening that we're seeing is people, essentially businesses, front running potential tariffs coming down the line. But net exports, it can be a pretty significant component into the headline GDP number. And so the Atlanta Fed, they have this kind of real-time GDP forecast for the current quarter. It's called GDP Now. And based on the incoming data, the data that was released this morning, that GDP Now forecast dropped to negative 1.5% for Q1. So according to that model, we're going to see a contraction in economic growth in Q1. But obviously we got a lot more to go in the quarter. So we could see this being revised higher if the data starts to improve. But I think by and large that did lead to some of the rally that we saw in treasuries.
Yeah, it's pretty interesting to see that negative 1.5 number. And it, as you said, it is all just kind of front running tariffs, or what it seems like. It's front running tariffs, and it seems like it's a pretty big move there. But really looking at it, it'll be interesting to see how that shakes out. Typically, I think when we've looked at GDP Now, historically, it starts high, and then as you get more and more data, it kind of trends down. So is this a reversal, or how are things going to shake out if we're going to kind of stay at this kind of negative 1.5 level, or the data, other subsequent data will help prop it back up to a different level? But it was really, I think we were at it was pretty high. Let me look and see what it was. It was pretty high before today's data print, right? So it wasn't something. It was just a one big shock. It hasn't been trending downward. It was staying pretty high before that.
Yeah, it was really just today's data that led to that big decline, and it was the trade data, and you just combine that with the negative spending data that we saw as well, and that kind of just led to a downward revision. But as we're saying, the negative spending data could be related to the weather impacts and a give back from the strong December. So we'll just have to wait and see how February and March pan out.
Yeah, I think that's right. So really, let's kind of move to things to keep an eye on for next week. It's a pretty, obviously we got payrolls on Friday, so that's going to be a big market moving event. See how that shakes out. But on Monday we get ISM manufacturing PMI numbers for February. That's expected to be a 50.5, so still above that 50 level. So still expansionary, but down a little bit. 50.9 was the last month. We get the ISM services on Wednesday. That's expected to be 53 flat versus the 52.8 prior. So a little bit of an increase there. We get Beige book from the Fed on Wednesday. That's 2 weeks before the next Fed meeting on March 19th. As is typical, we get jobless claims on Thursday. And then, as I mentioned, payrolls on Friday. So right now, the estimate is 158,000 positive payrolls, up from 143,000 the prior month. Unemployment is expected to be flat at 4.0. And then, just as reminders, labor force participation rate was 62.6 last month, and underemployment rate, the U6 number, was 7.5. So as we kind of see these things shake out, it'll be interesting to see whether, because people are seeing more growth, or they're potentially seeing more growth scares, is that going to start affecting the payroll numbers? And this is our first data point we get as whether it's confirmation or kind of moving the other way or other direction there from the payroll numbers. But I think that it's an important week, first week in March, and so we'll see how that shakes out. But I think that wraps it up for this week, Ryan.
Yes, thank you all our listeners out there today on DL Minutes. Hit us up on X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Our website is doubleline.com. For those of you worried about Trump's trade policy, we just put out Bill Campbell, Bill Campbell just put out a new paper assessing Trump's trade policy and kind of what we know, what we don't know, kind of how he thinks things are going to shake out. So that's interesting to read. That just came out, I believe, yesterday or the day before. So I read that at that point. It was time. It was good. And don't forget, our YouTube channel is youtube.com/DoubleLine Capital. I just finished watching the episode of Jeffrey Gundlach talking with Tony Robbins. Very wide-ranging discussion that obviously something that I highly recommend everyone to listen to and watch also. With that, thanks for tuning in and hope everyone has a great weekend.
Thanks, everyone. Take care.